All right, guys, I am here. Josh is here. Welcome. It's Live at 5. My name is Jeb Smith. I'm a real estate broker here in Southern California, as many of you know. But if you're new to the show, we're here to answer your mortgage and real estate related questions. So put those in the description below. Josh is our mortgage expert, and he'll be here to answer mortgage related stuff as well. But we do appreciate you guys being here. Not really a lot of changes in the overall condition of the market other than interest rates, which we are going to talk about today. I know we're going to get a lot of questions on, forecast of rates, what's going on with rates, and we are going to get to that in just a minute. But before we do that, Josh, welcome to the show.
Well, thanks for having us back, Jeb. I got a plant back here. We got rid of the wall of white behind us. So it's not a porn set like your fans were claiming yours was last week, but it is fancier. It is
my fans. That was my wife. She's my only fan.
She's the only fan. Maybe your kids on good days.
No, not even them. But let's talk. So every week, talk about inventory here locally, Orange County, where I'm located today. As of coming on the show, we have 1,044 active properties on the market, 3.3 million people. Inventory essentially is lower than the first week we started the year at. I did see it this week over 1,100 at one point. We've come back. So there are properties coming on the market. They're just going into escrow. And I've got several scenarios that I can talk about in my own experience of working with buyers, even listings I have, and some of the activity out there, which we'll talk about during the show. But here, Huntington Beach, locally, 69 active listings. I think last week we had 74-ish, if I remember correctly. I've seen as high as 80 this year. Today we had 69, and today we had 3 active listings come to the market. So without those 3, we're sitting in the mid 60s. So inventory, it's the big problem right now. Everybody's talking about rates. Rates are definitely a problem, so to speak, but you can't even find property to get a mortgage on for the most part. But I did see mortgage applications were up, Josh. Overall, they're saying purchase applications, I think, were up by 24% in the first week of 2022 or something along those lines. But let's fill us in a little bit and talk about that.
Yeah, so since you started there, let's just look. These figures, purchase volume in 2022 for the second week of the year continued to be strong despite headwinds compared to 2021, the same week last year.
Sorry,
Rates are
I'm
up.
sorry. Let me interrupt you. 2.3%, not 23%. Up 2.3%, not 23. Anyway, there we go.
Okay.
Yeah, correct myself.
So when compared to 2021, week two, rates are 0.75% higher than the last year. Loan volume is down, purchase volume is down 8%, according to this. So there's different numbers. This is American Enterprise Institute. Jeb's numbers are accurate after he corrected them.
Survey.
MBA is accurate. American Enterprise Institute calculates a little bit differently, but they're saying volume is down 8%, but rates are 0.75% higher. Compared to 2020, week two, rates are an eighth lower, while volume is up 28%. So there, year over year, 2 years, the volume is up. 1 year, it's down. So it tells you 2020, second week of the year, that was pre-COVID. That was a pretty good year. 2019 rates were low. The economy was doing fairly well. We had a lot of buyers. Like Jeb, if you look back, do you remember late 2019, early 2020 as a pretty good year?
Yeah, no, I mean the beginning of 2020 started off strong, right? And then we had COVID hit, things back down, right? March, April, but then, once you got the stimulus, you got some of these forbearance programs, things took off again. And that's really where, we haven't retraced since then. I mean, it's been almost like upward trajectory since that point.
Yeah. So absolutely looking at it here, and I actually realized I had not shared this. I'm going to put us back in little tiny boxes, Jeb. So these are the numbers. So up 28% over 2 years ago, down 8% from last year. We can all agree last year was just nuts. Everyone had come back into the market. Rates were really low. So that was what we were looking at. What I wanted to point out here, cash out volume remains heated. Equity gains are robust. So long way of saying cash out is up 89%. Cash out refinance is up 89% over 2020. Why is that? Because home values went up a ton. A lot of people who bought in 18, 19 with 5, 10% down didn't have a lot of equity. Now they're sitting on a ton of equity. Rates are still relatively low. What I see, this is anecdotally, this is coming across my desk. People hear this and they freak out and they go, oh my God, we're back to 2005. Everyone's pulling money out of their houses, using it like an ATM. For the most part, what do we see on here every week, Jeb? A lot of people are asking, hey, what if I pull some money out and invest in another property, put something in Bitcoin, whatever it is. More people are thinking in terms of investing versus spending. Most of my clients don't come in with a ton of debt, but some of them do. They have debt for a business they started, whatever. So we're looking at consolidating debt and making things better from that end. The big one that we'll see here, there's almost there's almost no rate and term refinances. People, last year, 2 to 3 loans a week would come in where someone, hey, I got a 3.5%. What can we do? Hey, we can do 2.75. All right, awesome. Let's do it. Now, when we're looking at, 30-year fix in the high threes, unless you were living under a rock the last 2 years, you've refinanced if you had that opportunity and were able to qualify. So at least for the first portion of the year, until rates moderate, if rates moderate a little bit, there's not going to be a lot of refinances, and that's just refi burnout. Most everyone who can and wants to refinance has already done it. So, Jeb, you talked about and asked about interest rates. I just wanted to show this chart. This big red line shows from November 5th of 2021. So a little more than 2 months ago, through December, through January, about 2.5 months. That line represents a 0.75% increase in interest rates. That's a really, really rapid run up. Jeb and I were talking in December. You guys were asking, what do you think interest rates do next year? And we give a pretty wide range, including possibly going down, more likely inching up and peaking somewhere around 3.5 to 3.75. We got there in less than 2 months, less than a month from when Jeb and I were talking about that. So do I think this is wrong? I don't think it's wrong. I think it's wrong that it got there this quickly. So kind of what I wanted to show, if you're on the wrong side of it, if you're in escrow and you didn't get locked, if you're out shopping for a home and so you don't have the ability to lock and you're seeing this, as soon as you have the ability to lock. I wanted to show, if you look, these red candles, those are bad days. So you don't need to know what it all means other than that's bad. Interest rates got worse on those days. So after this long run of almost nothing but red, you're expecting a green candle, a bounce, some sort of recovery. Even if rates are going to continue getting worse, they call it a dead cat bounce. It's going to bounce and give you some of it back. So this morning, we woke up to this nice run up. So this is just today. This is one chart that just shows just what happened today. So we're running up, tries to give a little bit back, runs up. Midday, we're feeling pretty good, up about 40 basis points, that we're going to get some of that recovery. Well, by the end of the day, it just sells off and closes, not the lows of the day, but about where it opened after this big, strong opening. So a long way of saying, when a market gets this bearish, we can sit here and say it's irrational and illogical that rates spiked that far that fast. But if you have the opportunity to lock your transaction and you're going to transact, you're in escrow, you're looking at a home, lock it as quickly as you can. I'm still of the belief that longer term, after the first quarter, first of the year, that things will moderate, but you have to see it play out. So, Jeb, I don't know if you wanted to go into this, but an interesting chart came across my desk earlier in the year. People are asking, there's a question in here, in terms of inflation, what's happening? Is that what's driving rates higher? And this was a chart that just showed what happened the last 3 years to American spending. So you can see from 19 to 2020, it was down a tiny bit. If you remember, we're all locked at home. It wasn't as easy to spend your money as it was previously. And then we go into 2021, it just fires up and goes. So the chart's not to scale. So it's not like there was quadruple the spending in 2021, but we had a massive increase in spending. What I thought was really interesting is this chart here that shows by Equifax risk score quintile. So basically, higher income, higher socioeconomic levels are on the right. The lower levels are on the left. And if you'll see, all through this time, the lowest quintile, the people that are most credit risky, they never had the opportunity to stop spending because they're spending the majority of their money on the basic daily necessities. So staying home doesn't prevent them from buying food, buying diapers, that type of stuff. Pretty much the same story for the second and the third quintiles. Now you get up to the fourth. So this puts you anywhere from the 60 to 80th percentile. They actually cut back their spending. A couple reasons for that, because they were panicked, worried about their jobs like everyone else was. But when they're locked at home, they're not taking vacations. They're not going to the movies. They're not running out to the mall. And the least risky group had the biggest dip. But what you can see is everyone has gone back to spending this year. So it was a 0.8 trillion increase in spending by this measure, a 13% increase in 2021. And what they're saying is this will help fuel aggregate demand and keep inflation at unacceptably high levels. We've talked about this, Jeb, here on the show for months now, that what happened here, monetary punch bowl, low interest rates, Fed waited too long to act, should have taken away that punch bowl in the middle of last year. The government was actually handing out money at the same time. So those things have pushed demand high and will keep pressure on inflation, which will likely keep rates a little bit to the high side. So when we're looking at it, what do we expect? Don't know what to expect here for the first quarter. It seems as though the market has overreacted to the knowledge that the Fed came out the last part of the year and said they're going to stop their bond buying, both mortgages and treasuries. Once that's done, they're going to raise rates. The market's almost priced in 3/4 point hikes. And beyond that, we don't know what happens. So that's the big update on where we're at and why rates have spiked so quickly. And hopefully it gives you some insights. It hasn't really changed the fundamentals, just markets act crazy in the short run.
Yeah, I think in layman terms, for those out there that don't really care about all of that, I mean, part of the problem is that no one truly knows. The markets don't know exactly what to expect from the Fed. There's so many different opinions on what's going to happen, right? Some are saying the Fed's going to raise 3 times, and you got others saying 4 times, and you got Jamie Dimon coming out and saying they're going to raise 7 to 8 times, which absolutely destroyed the market on Friday. And then in addition to that, you've got people saying, well, they're going to start raising, the Fed funds rate in March. And then you've got people coming out and saying, no, they're not going to raise it in March. They're going to wait till they're done, with the taper. And so there's just so many different opinions out there. The market doesn't know what to do until there's some certainty. Maybe once the Fed actually has a meeting and the minutes are released, that will give the market a little bit of certainty, some foundation to build off of. There's just way too much volatility at the moment. And that's the reason you're seeing these crazy moves. It's irrational because nobody knows truly what to expect from the Fed because they waited so long to do what they said they were going to do. It was transitory. Now it's not. So again, it's just a long way of saying that once there's a little bit more certainty in the market, I think you're going to see the volatility calm down, which should in fact help interest rates. Now, what that's not going to help is inventory, which in my opinion is honestly the bigger problem than the interest rates. And the reason I say that is because there are so many people out there at the moment that fear a rise in rates. And I can tell you this because I talk to, just my small sphere, the buyers that I'm working with and having these conversations. There's a fear that rates are going to go up. I would say, if I did a poll, which I probably should on my channel, asking, do you think rates are going to go higher than they are now? I think a lot of people believe that they are, and whether or not that's true. And so there's this fear buying at the moment, and I'm seeing it on the listings that I have. I'm seeing it in representing buyers. I mean, 2 buyers in the last week, very strong offers, 100,000 or more over the asking price and still not getting it accepted. I mean, in fact, I heard a story in my office meeting today that there was a buyer who offered $470 something thousand over the asking price of a home here in Huntington in order to get that property. And that's over a 10% move on the price of that property. So we're talking big numbers of people looking to get into property for one reason or another. So again, I know you guys are here to ask questions and have us answer them. So, we're running a little bit long here, but we just want to make sure you guys have all the info. Josh, anything you want to add on that?
No, just the big, you talk about uncertainty. The uncertainty is going to continue. A lot of this comes back to growth, inflation, GDP. And if you look, you're getting numbers all over the place, even on GDP projections as well, because Omicron kicks off in the fourth quarter. Now everyone's going, does that impact? Does it lower? Does it put a cloud over any numbers we get from the first quarter? You're looking for the reports to come out and give you some clarity. And now everyone's going to sort of discount all of the news we get here in the first quarter because of Omicron. So we will all be happy when the haze of all this washes away and we get a little more clarity on what's real underneath everything.
No, absolutely. And I've decided I'm growing a beard until inventory's balanced. Until there's 6 months of inventory, it's balanced across the board. The beard continues to grow.
I don't think
and
you're
so
tough enough.
if 90% of the YouTubers are correct, I'll be able to shave it off tomorrow. If not, it'll probably be here for some time, which is what I think. Anyhow, the last thing we're going to talk about, just because I pulled this chart up, we're going to pull this up here in the stream. This is the chart that I was looking at earlier, talking about mortgage applications. Now, this was from the MBA, Mortgage Bankers Association. Again, an increase 2.3% from the previous week. There's some interesting things in here. Purchase index rose 7.9% from the previous week, while refinances decreased, like Josh mentioned. Mortgage apps overall dropped 37.3% with a sharp decline in refinance. So almost 50% lower than the previous week with regards to from a year ago with regards to refinances. So, it's because rates are higher, right? You got less people able to take advantage of where rates are. And then it goes on here to basically say that the slowest pace of refinance in over 2 years was among FHA and VA. And we could get into that article. It's on Housing Wire if you guys want to pull that up. But that's that. So, Josh, let's get into some questions here. I did see Jennifer is here. Jennifer mentioned that she was going to have some potential routine surgery. So she's here. Hopefully she's well. If she had it, appreciate you being here. She is one of our moderators, so be nice to her. Otherwise, she has the authority to boot you, as many of you know. Afromex. Hey, Jeb, big fans here. Thank you guys for the support. We currently live in a home we plan to remodel and put on rent, and buy or build another home from scratch to live in. Is now a good time to make such a move? This is a common question that we get. It's one of those things that you've got, the fact that you're building might be a little bit easier, but also you're going to pay, an expense, a higher expense in this market to build versus some time ago, just because of, supply constraints on building materials. Contractors are more expensive. So it might not be as easy as just remodeling a home, putting a lease, and going out and building a home. It's, in theory, sounds like a really good idea, because again, rentals are in high demand. You can get, again, above asking price on rentals. I just did on one of the rentals I had. So yeah, in theory, it's great, but just make sure you've got your timelines in order. Overestimate on time, overestimate on the cost to build. If you're looking to purchase something, might be a little bit tougher depending on what market you're in. So just consider everything, and be probably more bearish on all of that stuff than you should be, just because of what's going on in the economy. Josh, here's one for you. Jasser Jenkins. So what's your take on Elon Musk predicting a mid-2022 recession? Now, you and I have talked about, the Fed raising the Fed funds rate, and them stopping the tapering, and potentially, the runoff and all this good stuff. It likely leads to a recession, right? But does it lead to a recession in 3 months, or are we talking later? I mean, we haven't had this conversation. So, thoughts?
It didn't have to lead to recession, but the way they've played it, it will likely lead to recession. I think mid 2022 is pretty early. Absent the Fed royally botching it, I can't see how. I mean, mid 2022, literally, we're talking 5 months from now, 150 days from now, we're going to go from 5% plus GDP to negative GDP. I don't see how it could possibly happen. But bigger picture, Jeb, exactly what you were saying is, if the Fed, hindsight being 2020 and us being armchair quarterbacks, if they had started tightening middle of last year, and not doesn't mean raising interest rates, if they had just started tapering off their mortgage-backed security purchases, their treasury purchases, and sort of slowed, and then early part of this year slowly raising interest rates, it could have been sort of a light tap to the brakes. They didn't do that. So the economy got going like a freight train, got going faster and hotter than it should have, because there was too much monetary stimulus. Now, when you hear someone, whether it's Elon or anyone else, saying that's likely to happen, the worry is they're going to go too far. Now we waited too long. Now, instead of tapping the brakes, we're just going to jump on the brakes, and it's going to bring everything to a screeching halt. I would be in the camp that it's going to happen, but mid 2022, I don't see how it could happen. Late 2022, mid 2023 would seem more logical.
Yeah, if you guys paid attention last week when Josh brought some of the charts up, from Barry Habib's, forecast on interest rates. In fact, I did a video where I talked about, his predictions as well. Typically, what's happened when the Fed has started to raise short-term interest rates, like what they're planning to do now, it's been 2 years. 2 years is kind of the number after they start to raise that Fed funds rate that you start to see the recession. Now, that puts us 2024-ish. I think, again, like Josh said, 2023 is probably the earliest you would see it, maybe mid 2023. 2024, probably you're full on in at that point, just based on the plan that they plan on taking at this point. But who's to say? It's really hard to predict what's going to happen. I mean, with coronavirus and all of these different things and different variants and different whatever, how they react to that, I think decides a lot for the future of or the direction of the economy per se. So anyway, that's my thought on that. Dan Parker is a real estate agent in San Diego. Dan has a YouTube channel that focuses primarily on San Diego. In fact, I'm going to be on his channel tomorrow night at 5:00 doing a live. I think I put the video on my page as well. We're going to be talking about basically Orange County and San Diego real estate. So if you are local and that's your forte, maybe tune into that. We're going to talk a little bit more specific about what's going on in those markets to give you an idea. We got Grace here saying what's up. Jose earlier, I think, or did he go down here? Jose goes on to say, will lenders start offering 40-year refis in 2022, 23? So that's his question, but I like his comment better than his question. He says, you look like a Orange County vato. So anyway,
too much time in Santa Ana. I like tacos.
There you go. So thoughts. We've talked about 40-year loans before. Do you think that that's something that could become a product to make things more affordable? Josh, I know currently the way that it's written, it can't be, but thoughts on it?
I'm just running here. Let's look at it this way. $400,000 loan. Some parts of the country it's big. Some parts of the country it's small. Let's say rates keep trending up and you're at 4%. And so the answer is, hey, let's do a 40-year term. The payment on a 30-year loan at 4% is 1909. If you stretch that out 10 more years, you drop that to 1671. So $230 a month. But if we look at that, that's $800,000 over the life of the loan versus 687. So it's costing you $125,000 to lower that payment $230 a month. The funny
But
thing
let's be
is,
honest, nobody's looking at that, bro, when
yeah,
they get a mortgage. I mean, people are, but not the majority of people.
and you know what? I'll go back. We talked about here. There's a lot of cash out refinances going on right now, but it's really important that people not use their home as an ATM. Don't go back and buy boats and crazy stuff like people did, 20 years ago, 15 years ago. It's also important that we begin with the end in mind. Part of why we talk about homeowners have 44 times greater net worth than renters. Part of that is because they don't use their home like an ATM. They don't take long terms. They don't keep refinancing and starting over at 30 years. One of the big things that with all of our clients, that when we're going to do a refinance, when rates are low, when we're doing a rate and term refinance, if you're 4.5 years into the loan, it's easy for me to go, hey, we're going from 3.5 to 2.75, and a 30-year loan, just like you have right now, is going to drop the payment X number of dollars. If you say a 24-year loan is going to not have nearly the savings, but that's the loan you have. Once you're 6 years into a loan, it's a 24-year loan. So going back to a 30 starts you back over. Taking a longer term keeps you further from owning. We've talked about this. The prime age for first-time homebuyers is 33, 34, 35. You take a 40-year loan, if you never move, never refinance, and just paid that thing down, you don't have it paid off till you're 75. We've talked before on the show that people are living longer, and that retirement at 65 is pushing more to 68, 70, 72. So maybe that coincides with it, but I don't know that it's really a solution. I would rather see, no, I don't want to be Dave Ramsey and say, hey, only do a 15-year loan with 20% down and pay off all your debts and don't have credit cards, but somewhere in between, a happy medium of those two ideas.
No, agreed. Neil is saying, great show. Appreciate it. Just curious to get your personal experience with appraisals. How often do they come in low? What's the biggest difference you have personally seen? So Josh is probably going to be able to answer a little bit more, give you some more knowledge on this than me, just because he probably sees more appraisals than I do, just because of the sheer number of transactions he handles versus me. I think last year I closed 31 sides on real estate, right? So there's not a lot, and most of those are listings, so I don't necessarily get the appraisal per se. But what I can tell you is that I personally did not have, knock on wood, an appraisal issue last year. Now Billy on my team had 2 transactions where there were appraisal issues. One was $5,000, not a big deal. The other one was about 15 or 20,000, I don't remember, but we were able to actually, believe it or not, negotiate both of them. And so it didn't end up affecting the buyer in a negative way on either of those. But I do know there are issues out there with appraisals in some markets. One thing I should have started with when talking about the show in general is just real estate's local, right? So when we talk about real estate, you guys hear me say this, we're talking what we know here in Southern California. I'm talking about Orange County primarily. Now you can take that and use it for LA and San Bernardino, San Diego, Riverside, just because it's kind of happening all the same, but you can't apply what I'm saying here and say, let's go to, Wisconsin right now, right? The market is probably different there. So just make sure you're using that information. But with that said, Josh, appraisals, how many last year did you have come in less than where they should have been?
I would say less than once a month that we have to deal with it. And the majority of them were in the spring on purchases when we saw the big spike in prices, and it was just really, really hard for appraisers to find comps. We're seeing a little bit of a spike here, again, the start of 2022, but not so far as bad as last year. It's not, for us, it hasn't been that common. I would say once a month, twice a month, and a lot of times it's on a refinance. And you say, how does an appraisal come in low on a refinance? It comes in lower than what the borrower believes it is worth, and it sometimes comes in lower than what we think it's worth based off of researching all the comps. And it just comes back to debating and duking it out with the appraiser, and it comes down to the quality of the data you have to fight them with.
Now, I would argue one of the things you said in there about appreciation. Right now, I came out a couple different times last year and said I don't think the spring is going to be as hot as the previous spring. I'm starting to question my thoughts on that, just because of the transactions that I've personally handled in the last two weeks. I mean, since the beginning of the year, 3 weeks, right? I mean, I put an offer in last weekend. Property was priced at $1,350,000. The last supporting comp identical to that property was like $1,250,000 or $1,275,000. It was $1,350,000. We offered $1,360,000, and we were told that it sold for substantially over the asking price. My client was all cash, 10-day close, all cash. I mean, free 60 days of rent we were offering. I mean, it was a solid deal. And guess what? We got blown out by somebody that was willing. So you're talking, in that case, at least probably $100,000 over the last closed comp, which wasn't that long ago. So on that purchase price, what are you talking? 7-8%? I mean, right there, the first 2 weeks of the year. The other one I mentioned last week, Garden Grove. Okay. I mean, depending on, whether you feel like that was priced fair or not, we're talking again, another 7 or 8% increase. I just listed one here in Huntington in a higher price point. And I mean, it probably sold for, quite a bit above what I thought it would. I mean, I don't want to go out and say anything at the moment because it's not a closed transaction, but it's substantial. I mean, we're talking big numbers in increase. So I still think it's going to be slower growth than last year, but I don't know by how much until you start to see some inventory, you're seeing crazy stuff out there. So at least here locally. Anyway, we got Willing in the room. He's looking for Ashley Wolf this week, of course.
The funny thing is, I have no idea why this thought came to me this morning, but I said, I wonder if Ashley will be there for Willing to flirt with the whole time during the show.
I hope.
And also if he is truly flirting with himself and has the Ashley profile up on his laptop and is just chatting back and forth with himself.
Either way, it's entertaining and I like it. Let's see here. Our prices still are rising now. Max asking. I'm seeing it here locally. In our market, prices are still moving upwards. Worst case is sideways, but I'd say upward. Pretty much everything that's coming on is, in my opinion, priced a little bit higher than I feel like it's worth. And I'll tell you, that's a problem for me as an agent, right? Is that, I'm seeing properties come on and I feel like, wow, that is priced high. And then it sells. And I'm like, okay, was I wrong, or did the market just demand a higher price because of what's going on? So it's not exactly, easy at the moment to tell you what a property is going to sell for. What do we got here? So Crazy TV. I'm going to go with crazy on that. I just like the letters put together there. It gives me crazy.
It could 0.75 cozy TV. She might be
I like crazy. Crazy's better. 0.75 in interest rate. Is it true it's around 100 to 125 additional to the monthly mortgage? So Josh, what do you have a simple calculation on?
No, it's going to depend on your loan amount. So here, let's look at it this way. $1,000 or it's probably easier to do 10,000. $10,000 on a 30-year at 3% is $42. So at 3.75%, it's $4 more per 10,000. So $40 per $100,000. So if you're buying a $300,000 house, $40 per 100,000 would be about $120. So if you're in that 300,000 loan amount range, yeah, 0.75% increase would be about $120 a month.
There you go. Let's see. I'm just going through some questions here. Victor saying, can my fiance and I buy a home as co-buyers, or do we have to wait until we get married? Do they take an average of both of our credit scores? So, Josh, you're buying a house with a spouse. Is that any different than buying with a girlfriend or a fiance or a boyfriend in that case? How do they calculate income? How do they calculate credit score? Let's give us a brief rundown.
Whether you're married, not married, basically all of the income goes into a pile and all of the debts go into a pile, and we calculate the debt to income ratio. So again, married, not married, doesn't matter. The only situation where it does matter on a VA loan, co-borrower has to be married, it has to be a spouse. So we'll have fiance run down to the city hall to get it done, and then have their real wedding later on so that they can buy their house and both qualify if we need both incomes. Now, in terms of credit, this is where it gets important. They do not take an average. We're 99% of loan programs and all of FHA, VA, Fannie, Freddie, and most jumbo loan programs, they're going to take the median score. So if you have 3 scores, 3 bureaus, they're going to take your middle of those 3, and of the 2 borrowers or 3 borrowers or 4 borrowers, they're going to take the lowest middle score of all borrowers on the file, which can be traumatic. We have situations where one spouse has perfect 780 credit score, or one borrower in a transaction, and the other one's like a 650, and they're shocked and dismayed to find that we're going to work with the 650 credit score.
Got it. Good stuff. I know you have a calculation for this, so we'll just run with this one real quick. Driver's seat, is it worth refinancing with $56,000 left on a 30-year, $360,000 mortgage? So originally the mortgage was $360,000. They now owe $56,000, have a rate of 6.75. Rates currently, depending on what type of property that is, credit scores, all that good stuff, are probably somewhere in the high threes, mid threes. Does it make sense to refinance that, Josh?
It probably does, as long as you're willing to jump through the hoops and you're able to find a lender that can do it. You're going to say a lender that can do it. It's very difficult with the federal laws of what can be charged on a loan to remain compliant on the smaller loan sizes, because a lot of things like an appraisal are a fixed cost. If you have a $500,000 loan or a $50,000 loan, the appraisal is going to cost the same. Escrow and title have a floor rate, the lowest that they can charge. So all of that makes it difficult. So I would check with a bank or a credit union. They're more likely to be able to accommodate that for you. But the rule of thumb is we take 125,000 and we divide it by your loan amount. It tells you how much you need to save. So we take 125 divided by 56. It's about 2.25%. So anything under 4.5 would make sense for you, and you should be able to get something in the 3.75 to 4% range. So I absolutely think it would be worth checking out. But would also want to look. You say it's a 30-year mortgage with 56,000. You know, you've paid off 5/6 of that loan, so there should only be 6-7 years left. Probably want to look at making sure you're keeping that term shorter as well when you're lowering the interest rate to keep you on pace, or at least doing like a 15 year. So that 15 years probably going to be lower and closer to 3. So long answer to a fairly simple question. It probably does make sense. You may have to check and shop a little before you can find a lender who can do a $56,000 loan.
All right, there you go. IRL is dead. Errol is dead. I'm not sure. Rates will be high, but prices won't go down much because no one is going to want to sell. So I did this. It's not a question, it's a comment, but there's some truth to that in my opinion. I think you have people that have locked in super low interest rates, super low payments, and the idea of letting that go and selling that property and buying something else, whether it's a higher interest rate and a higher purchase price or whatever, I think you're going to have more people stay put to some extent, right? Not wanting to either let that property go, maybe turn it into a rental because the rate is so low they can have positive cash flow, and or just not in a position to want to pay higher price and a higher rate to buy a property, because that's like a double whammy, if you will, right? So I think there's a lot of truth to that. That's going to, in my opinion, going to also affect the inventory, which is likely going to keep it low.
You know, Jeb, we should dig in, and the numbers we know, just the supply of homes on the market, say that he is right. No one's going to want to sell. So right now, there's very few people that want to sell relative to the number of people that want to buy. But there's probably some numbers that we can dig into and why that is. We've hinted at it and gone through it in a little bit of depth previously, in that boomers are basically aging in place, not downsizing, not moving away. They want to stay close to their family and grandkids. And when we have them pass away, we have older people pass away, see a lot of family members are keeping the properties as rentals, keeping them and stopping becoming a renter and moving into the property themselves. So there's not nearly the supply coming to market that you would expect. And we've talked about sort of the backfilling of generations. It's morbid to talk about boomers and older starting to die off and have increased mortality rates, but that millennial generation is filling it up and more than accounting for that demand that's going away with people passing away.
All right. I don't know if this is one we can answer quickly, but let's try. Flashlight. What do you guys think of Unison versus HELOCs, cash out, and reverse mortgages? So, I don't, there's a lot going on there. All of them allow you to pull property or cash from a property in some form or fashion, right? A HELOC kind of works like a credit card. You pay down the balance. I mean, you borrow money, you can pay it down, reuse it. A cash out refinance, you pull cash out of your property. There's no reusing it. It's cash in your hand. Reverse mortgage, essentially they pay you every single month or a lump sum up front in order to, but you got to have equity. You have to have equity in all these situations. But Josh, and I don't know what the hell a Unison is, so maybe you can enlighten me on that.
So Unison is basically a fund with a lot of money, and they're looking for ways to generate a yield on it. My wife used to work for a company called Mobility. Mobility owns cell towers. So you might have a piece of property and they would build a cell tower on it and they would lease that land from you. Well, it looks like a 30-year lease, but it's actually renewed every 5 years. So Unison started calling and saying, we'll buy out the lease and give you the cash up front, and scaring the people saying, hey, it's not really a 30-year lease, it's a 5-year lease. They can pull it off the property at any time, despite the fact that that was highly unlikely. So Unison has moved into a bunch of different areas. And I believe, I haven't looked into what they're doing to chase yield here, but what they'll do is they'll give you cash for a partial ownership interest in your property, and they're going to participate in the equity appreciation moving forward. So again, it's just money looking for a yield. It's just money looking for a yield.
Yeah, don't do that. So out of those options, Josh, reverse mortgage obviously is a different situation, but between a HELOC and a cash out, right? If you're considering one or the other, have a lender run both scenarios, figure out what, is the best situation for you, scenario for you. Easy to compare when you have it all on paper, side by side. That way you can, yeah.
Jeb, an easy answer with the HELOC versus cash out. A month ago, it was easy, do cash out. And I could give you the boring reasons. HELOC is variable. It's likely to go up. It's directly impacted by the Fed raising rates this year. But the majority of people that I talked to had a conversation this morning. These folks owed $340,000 on their first at 2%, and they wanted to borrow $125,000. So you go, do you want a 3.75 rate on $465,000, or do you want that 340 at 2% and a variable rate HELOC? So they obviously opted for the HELOC, and the numbers right now are sort of trending towards that direction. So you have to look at what's the interest rate on your existing first, how big is your existing first, and then how much cash do you want out. If it's a little bit of cash, 20, 40, 50, $80,000, and you owe 300,000 plus at a really good rate on your first, it's leaning more towards a HELOC, despite the fact that that interest rate is going to go up. So that's the HELOC versus cash out. Reverse mortgages get a bad rap because of a lot of bad actors in the industry that do some things that they shouldn't, but a reverse mortgage from a reputable professional can be a very good tool for accessing equity without having to pay it back like you will with the HELOC or the cash out. So if you have the ability to make the repayments, it's cheaper to do a HELOC or a cash out. But if you don't want to make the payments or can't make the payments, a reverse mortgage can be a very good option. Just be really careful who you're talking to.
Absolutely. And so that's going to bring me to this. If you guys need a real estate mortgage professional anywhere in the country, click that link below. You can't click, you got to type it in, but it'll take you, right? I have a lot of you guys reaching out saying, thank you for referring me to whoever it is in different states. I know the people, but if I listed all the names, it would take a while. But depending on where you're looking, we know someone that can guide you in the right direction. Doesn't matter if you're looking for an agent, looking for a mortgage professional, maybe looking for both. here to guide you through that process. Again, these are people that we know, like, and trust, and will take great care of you. So that link will get you there. And Josh, while we're on this, construction loans, do you have an opinion on construction loans? I know you don't do them, but thoughts on them?
We talked about this, probably a couple months back. Someone had asked, for someone, especially as a first-time buyer, it's just a complex process. Picking a builder, finding a piece of land, going through plans, permitting, managing that budget, managing the process over time, making the payments or accruing payments while you're in the construction period. To me, it's more of an advanced strategy for someone who's not a first-time buyer. They've already been through it. They have an idea of exactly what they want in a home. They may own a piece of land or have their eye on a piece of land that they like. So I wouldn't look at it as a tool to get out of competing with other buyers in the market just because of the complexity of it, but just see where you fall on that spectrum. Do you have a piece of land? Do you have experience? Do you have a construction background? How strong are your finances? How big of a down payment are you looking at?
There you go. Good stuff. Let's see here. CZY TV. Maybe you can tell me what we're pronouncing here, so I'm not butchering this every time. But do pocket listings not post the home sale online, like in Zillow, et cetera? Wondering how investors are using this in their buy-sale transactions. Yeah, so typically pocket listings are not posted anywhere. They are pocket listings, right? They are only, I might know a seller that's willing to sell our property, but there's a reason it's a pocket. They might not want it on the market for whatever reason. There's a lot of different scenarios where a pocket listing might happen. South Florida, Miami, a lot of money, a lot of celebrities, a lot of off-market sales for one reason or another. People don't want their business out there online. They don't want the neighbors to know. They don't want whatever it is. So therefore, that's the reason for pocket listings. Now, a couple years ago, they basically came out with something that basically made pocket listings illegal, which they still happen. But the idea is that, you aren't technically supposed to have pocket listings, but they're happening all day long. So, but no, they're not posted online. You got to find an agent that probably does business in your market that networks with other agents, because that's how we find out about these, right? Like agents in my office, we might mention, hey, I have a seller that's willing to sell a property. If you have, somebody looking for this or what have you, and that's how transactions happen. So that's how it happens between investors too.
But think in terms of it, why would you be interested in a pocket listing? It's not a discount. It might be an in the current market. But Jeb, we've talked about this before. You've had several homes that people became aware of before you got them on the market and have reached out and asked, well, what's the price to not put it on the market? And generally, what they're thinking the price to not put it on the market is less than what those homes ended up selling for, right?
Yeah, I mean, I think that's their thought, but I mean, I just had one like that, and they ended up paying quite a bit more for it because my client, the seller, was like, "We're going to put it on the market unless you're willing to pay X," and the buyer was willing to pay X, and therefore, it is on the market, but it never actually was able to be shown because of the buyer came in and made an aggressive offer. So. As a seller, honestly, it's in your best interest to put it out there for the most, usually, just because if there's one buyer willing to pay X, there might be multiple buyers willing to pay X. And in fact, if you don't get the multiple buyers, the first buyer might still be willing to come to the table and do it. So it's usually how you get, the highest, exposure drives demand, demand drives price, right? So if you want the most money for your home, you need the most exposure, you need demand to drive that. And so the more people that can see it, you might get that, or in theory, you would get it. So Cheesy Black. Last week, was it my first on your channel? My husband does not want us to buy a house. He feels mortgage is a modern day slavery. You're on the wrong channel here.
It's an aggressive term.
We save about $8K. We've saved about $8,000. What should we invest in instead of buying a house? So listen, this channel is all about real estate. So if you're not looking to buy real estate or become smarter around real estate, we're not going to give you a lot of value here. We don't really talk about investing in other things. Invest in yourself. I don't know. I mean, Obviously, there are other things out there that can get you a return or whatever it is. Just, make sure you understand what you're doing. You have a longer term time horizon. Any investment, whether it's a stock, crypto, real estate, you've got to have longer term time horizons. If you're looking to make quick money, overnight success, you're in a fool's game. There's no, I don't have the answer for you, but I could tell you if you're looking to invest in equities, stocks, and or real estate, either of them are a good choice long term, in my opinion. Obviously, there's better times to buy them than others, but long term, I think either of those are good options. Josh, anything you want to elaborate there?
Yeah, what I would say is, in 26 years of doing this, when I hear anything along those lines from one spouse versus the other, how do you argue with it? You can't really argue when someone tells you it's modern day slavery. So what it really is trying to shut down the idea of buying a house. He really just doesn't want to buy a house, because if we want to debate what's more akin to slavery, choosing to invest in owning your home, or being forced to pay rent to someone else at whatever rate they want and move out when they want and do what they want when they tell you how you can do it. So it's an impossible argument there to have. But really, just having gone through this with multiple spouses before, where one spouse wants to buy and the other one doesn't.
How many spouses have you had?
Well, I haven't had any spouses. I've talked to lots of folks and their spouses. But she follows up here with, what is the advantage of waiting 5 to 7 years and buying a house cash, or buying now via a mortgage? 650,000 price point house. So I'm hoping then what she's saying in the previous one here is they're saving about 8K amount, 8K a month. If you're saving 8K a month, then that's 100 grand a year. In 5 to 7 years, you'd have 700 grand. And in that case, if you guys are making money like that and saving in that way, your husband's right. I don't want a mortgage. I'm going to be my own bank. I'm going to save up the money,
Right.
and come in and buy free and clear. I love the idea. It requires a discipline that most people don't have, and an income level that you don't have. We talk on the show that most people are not able to save as quickly as home prices go up. A $600,000 house at 3% appreciation in 7 years is going to be an $800,000 house. So just remember, you're going to have to be growing that money that you're saving along the way. So if you're in a position to be able to save $80,000, $100,000 a year, it's definitely more viable for you than it would be for someone at a lower income point and without the discipline to do the savings.
Good stuff. Let's see what we got here. Crystal is asking what the winning offer terms for my offers comparison video. Honestly, I don't remember the offers in that video. Hard for me to say what they were. I think I talked about what the winning terms were, but essentially what I'm seeing at the moment is I'm still seeing appraisals being waived. Home inspections, not really. I am seeing some loan, I can't even think. Loan contingencies being waived as well. So I'm seeing appraisals and loan contingencies being waived. Those are really the two at the moment in these offers. I am seeing above asking price on multiple properties. I have seen some escalation clauses. I've seen a lot of cash, like a lot. I mean, we're talking, and we're not talking $100,000. We're talking million plus on $1.3 million, $1.4 million on some of these deals. Cash coming out the woodworks. And guess what? Interest rates don't affect that cash. And so their purchasing power isn't changing. And so now, again, I'm in Southern California. I'm in a market that has, that as a whole is pretty, well-to-do financially. I mean, there's a lot of money floating around us. So we are probably seeing more cash than some other areas out there. But, it's hard to compete when you're against cash and people are doing some of these egregious things with regards to writing offers. But I don't remember specifically in that video. But if you have a specific question, I can probably answer it. Isias, Isaias. Yes, I guess. Sure. FHA raised limits. Why? So why does the FHA and Fannie Mae and Freddie Mac raise the loan limits every year, Josh?
Home price inflation. They're trying to keep the program available to the same general pool of potential buyers. So FHA in most parts of the country, for us in Southern California, in the Bay Area, we are really lucky that the FHA limits match the conventional limits because of home prices here, so it's an option for both. But most parts of the country, FHA has a lower loan limit than conventional loans, and the reason for that, and their reasoning is they're trying to help people at lower price and income points get into their first home. There's no income limits, so anyone income-wise can use it. They're just not trying to use the program to help people buy, really expensive homes. But with that, every year they just increase based off of inflation in homes. If homes didn't go up in price last year, they wouldn't have raised the limits.
There you go. Good stuff. Here we go. Sunny. Would you recommend cashing out equity on one rental to buy the next one in a year or so? Josh.
I'm not against it at all. If you have the equity, you want to free the equity so that you can invest it. We talk about in the show, again, maybe we're too conservative. I keep hearing myself say, like, don't use your house as an ATM, pay the house, keep a shorter term. What I don't want to see is someone take so much money out of their rental that it's barely break even. If you have equity, you probably have nice cash flow. So use the measure of where your comfortable cash flow is to decide what to do. But the follow-up actually was before it. He missed the boat to refinance. The original loan is 4.25%, but I wanted to cash out. Your rate's not going to be a lot worse than that. Maybe it's 4.5 with 0 points, maybe 4.25 if you wanted to pay a point. So you can likely access that equity. My advice would be just make sure you aren't getting too aggressive and taking more out of that home. If you have a good income, a lender will let you take more out of a home than probably is prudent. I always like to see rentals with a nice chunk of cash flow and at least a 100 or 2 positive to give you a little rainy day fund without having to come out of your own pocket.
Yeah, I mean, one thing you mentioned in there, Josh, if you are going to pull cash out of a rental or an investment property, just make sure, again, run the numbers to make sure it cash flows. You're not putting yourself in a position where, maybe you're upside down on that mortgage now, because what happens, and again, also make sure that you have funds outside of that in case you lose your renter for a period of time. What happens if your renter doesn't pay rent or your renter moves out, you can't find another one for whatever reason? Don't use all the cash you pull out to buy an investment property and not have any reserves, right? Obviously there's more to Josh just answering the question saying, yeah, it's a good idea, but just make sure you factor all these things in, right? It's not just, again, we say it's not black and white in some of these scenarios, right? There is a little bit of gray area, some things that you need to consider in order to make that decision. It's going to be a little bit different for everybody, right? Everybody that owns a rental shouldn't necessarily cash out. Some may because of the amount of equity. So just make sure running the numbers, you're making sense of it. It makes sense to you financially, and then make the decision. Al Bundy, what's up, guys? Asking, what is a Redfin partner agent? How does it work? So Redfin initially came out with agents that worked for Redfin. Those were agents that when you searched online to search for a house, that agent that you found on there was a Redfin agent. Now they have something called a partner agent. A partner agent is basically an approved broker with Redfin, where they send you buyers that are looking to purchase, online, and essentially they take a percentage of that commission, right? It's like a referral, if you will, from another agent. They take a portion of the commission because they're giving you that business. You have to be approved. You have to be vetted. So that in fact, I am a Redfin partner agent. We don't really do any business off of it because of the price points that we're in, but occasionally we'll get somebody that comes through it that we're able to help. So just means you're a broker. I'm with Coldwell Banker, but I'm also approved to do business through Redfin's partner program. So that's essentially what it is.
I'm nominating the next one for question of the day because it's counterintuitive, but it's actually really smart. Inez Ferre says, hi, do you think inventory will slow down even more if rates reach 4% because homeowners will not want to let go of their homes if they're locked in below 4%? So everyone's focusing on, hey, demand will slow down if rates go up and people don't like the payments they're looking at to buy a home. But it could absolutely be a break on supply. If you're posted up in a home with a bunch of equity, a low loan at a really low interest rate, and you go, if I sell my house, I have to give up my $250,000 mortgage and take out a $500,000 mortgage, and I'm going from a 2.5% rate to a 4% interest rate, it will absolutely cause some people to not come to market, just like it will cause some buyers to choose not to buy. But what are your thoughts on it, Jeb?
I mean, yeah, it's essentially the question we answered a little bit ago, or the comment that one of our gents made up here. I forget what the name was at the moment. IRL is dead. Basically saying, rates will be high, but prices won't go down much because no one is going to want to sell. To me, it's the same type of thing. People aren't going to want to sell their property because the rate's there, which is going to keep inventory low. So I agree 100% on that.
If you
Jerry,
want a little more on that, go back and watch the open from last week. We talked about why I still do not believe that we are heading to a longer term higher rate trend. It could be a year, it could be 2 years, it could be 3 years, but rates cannot and will not be in the fours permanently. Maybe they don't go back to the twos, probably will even go lower than where they were eventually, because we have that 40-year trend in interest rates still intact, unlikely to be broken for numerous reasons. But in the short run, definitely we're looking at that.
All right. Jerry, unfortunately, we're not going to answer this because we just kind of touched on this question as well. It was a little different scenario, but that everything remains the same and as far as what you should consider when doing that sort of thing. So if you're just now watching, just go back, maybe 5 minutes and check that out. Gabriel Cardoz, what are you guys seeing in markets such as Tampa, Clearwater, St. Petersburg? So me being in Southern California, not seeing a lot out there. I do have agents that I know personally in all three of those markets. In fact, there are people that I talk to probably 2 to 3 times a year. I do know, following these people on social media, that their markets are in a frenzy as well because they're great climates. People are moving to warmer weather. They're all surrounded by water, beach areas, boating, all that good stuff. So the markets continue. Yeah, exactly. So, I mean, I think probably low supply, high demand. All of these cities, where you're talking about, are pretty built out, right? Because they're on the water. So, there's demand for that. If anybody's building new stuff, it's probably not on the water, on the channels, on, an access point to the water. So, which means, probably less desirable than the stuff that's out there at the moment. So, supply low, demand high, things continue to move. I mean, I don't see much changing in that market. But again, if you want somebody specifically for those markets, reach out to me. I know agents in those areas, mortgage people in those areas that can really answer exactly what's happening in that market. What do you got? Sunet. Our approval monthly is $1,472. How much is the loan amount with NACA? No idea.
No idea.
I don't know what rate that is. I don't know anything other than what you gave me there. So that is an impossible feat to give you the information you're looking for there. So sorry about that. Willing is still looking for Ashley. Looking into the Magic 8 Ball now. Hopefully Ashley shows up. How does buddy Victor?
You already got Victor's answer.
Victor, your question was answered at the beginning of the show, my friend. Go back and check that out if you didn't check it out.
But hold on. Shanice has the best advice for him, better than we gave. You should have checked her credit.
Yep.
Shanice is right. Don't listen to us. Listen to Shanice. So when you start dating and getting engaged, pull the credit and figure it out.
Exactly. Okay. How does using a 401k as a down payment work? Do you recommend doing it? So Josh, 401k, I pull it out. I'm essentially paying myself, right? Do I need to pay that money back?
Well, yeah, Jeb, that's the important question. Let's look at two sides of it. There's the wrong way to do it, which is you can take a withdrawal, and if you're not of retirement age, you're going to get taxed and you're going to have a 10% penalty on it. So please, whatever you do not raid your retirement account to use it for your down payment. But what Jeb was alluding to is you can take a loan against it up to $50,000 to use for the purchase of a home. You actually have to provide your contract and your estimated closing statement to show what you're doing to access those funds. But in essence, the plan administrator is going to have a loan plan. So instead of being invested in a mutual fund, you're invested in a loan to yourself, and that rate of interest gets paid back to you. So again, you're not eating the seeds, you're not making your savings go away, you're going to repay it to yourself. So on the loan side, we do not account for the payment on an FHA loan, Fannie Mae, Freddie Mac, VA. We don't have to account for the 401k loan repayment, since if you default on it, you're defaulting to yourself. But you want to account for it because your paychecks are going to be less every month in terms of qualifying. So it can be a great way to get into a home. My recommendation, I have people all the time saying, hey, I want to take out the full 50,000. I want to put a bigger down payment. I want to buy my interest rate down. Take as little out as you can to get your transaction closed, and then pay it back as quickly as you can.
Really good advice. One thing you mentioned in there, Josh, about paying yourself back at coming out of your monthly wage or your weekly wages or whatever, however it's accounted for with your employer. It's important, right? When you're budgeting, you've got to factor that in, because if it's a payment of $200-300 a month, that's a big amount. That's a big amount for a lot of people, and so you need to make sure you're accounting for that. That's why budgeting is super important when going through the home buying process. Prior to ever talking to a lender, have a budget in mind so you know what to expect, so there's no surprises. Now, this is the point in the show. We're an hour in, 309 people watching. I ask a favor. If you find any value at all, hit the like and subscribe. We have 63 likes at the moment. There's 300 people. I've never seen it go over 200 in the 2 hours that we're here. Last year, 48 episodes, 96 hours, never saw it over 200. Help us hit it. How's that? Thank you. That will be my one plug for the show. I'll probably say it again at some point.
You only
for all
need
you people that don't pay attention.
Two out of every 3 of the 309 here to just hit the like, and you'll get it.
I know, but people are like stingy with that. Stingy.
Here's
let's see here.
a question, Jeb, for
All right.
you as an agent. Are sellers shying away from offers with Bank of America home loans? And just answer this: big banks in general, Wells, Chase, B of A, for the most part, they're all the same in terms of how they process loans. And any of the big national credit unions, any lenders that you or your sellers would shy away from taking an offer from?
I personally, I think it's less the sellers than it is the agents, right? I mean, we usually guide our sellers with advice on lenders and timeframes, because they're not privy to what's going on in the industry, right? They see Bank of America, they think, great, big bank, must be great. No, it's not in many situations. Now, I will say there's caveats to that, right? I do know great loan officers at Wells Fargo that can get loans done all day long. But that's not the overall consensus for them, right? There's many people that work for these big banks that aren't the pros, that don't have the pull, that can't get things done in a timely manner. So it's not a hard and fast rule with any of these. Like, I know a great loan officer at Chase here in the harbor, right? He does a really good job. But overall, when I see one of these bigger banks, I try to shy away, just because, again, it's more clunky, right? There's more protocol, there's more steps, layers that each one of these, even if the loan officer wants to do certain things, a lot of times they don't even have the authority to do it, because there are so many layers because of banks and FDIC and just so many different things going on that it's more cumbersome as a whole. So
Jeb,
the easy answer is yes. Yep.
Jeb, you said something really important there. If for any reason you wanted to get a loan from a big bank, say B of A, I don't know if they're still doing the grant, but if you're like, hey, I think I'm eligible for that, I want to go that route, please, dear God, whatever you do, do not call the phone number on the website and get routed to a call center.
No.
Like Jeb said, he knows a really good loan officer at Chase. That guy's not sitting there in their call center waiting for the phone to ring. He's actually out working with professionals and networking for his business. So go online, look for, like in LinkedIn, a local loan officer that works for one of them and has access to those programs. Still not going to be perfect. They're still subject to those bureaucracies. But just like Jeb said, I know some really good loan officers that do work at big banks, and there are benefits to doing that. It's why they do that. But it's not the kid in the call center just waiting for the phone to ring.
No, absolutely. And with that said, I have someone at Wells too that could do the same thing. So both of those, you need somebody, reach out. I can definitely direct you if you're set on using those. But even if you are, get a comparison with somebody else, just to make sure you're getting the best deal, terms all the way around. Good stuff. All right. Jay Razon. I have a question. We currently are in escrow for a single family home in Upland. Last week, our loan officer sent us a loan application that he said he locked in rates at 6.375. He goes on to say super high interest rate because it's a bank statement loan, both self-employed. He's updated me every day saying he's waiting for the bank approval. We're getting super nervous. We waived all contingencies. Do you think the bank is struggling to approve people now because of the rise in interest rates? Potentially. Here's what you have. So you have a non-QM loan. These loans are just as a whole more difficult for lenders to get through to underwrite and approve. So where Josh might have a conventional loan, somebody putting 20% down, 5% down for that matter, high credit scores, loan approval probably same day, next day, right? Quick. Same borrowers, if they were bank statements doing a non-QM loan, that loan might take 3, 4, 5 days, or maybe a week in some cases, just because the lenders that do non-QM loans are a whole different animal as you know in itself, and a lot of them don't necessarily have the manpower to handle the volume that they have coming in. And there's just, again, there's layers to this sort of thing, and certain things have to be approved and boxes checked and so on and so forth. And some of the guidelines aren't super clear on some of this non-QM stuff. Some of them can do, make some exceptions here and there to get things done. So as a whole, I would say, taking a little bit longer is normal, but Josh, rates rising, non-QM rates rising at the same time.
I hope Jay is still here, because I would say on our non-QM stuff, they've held the line a little bit better than our conventional loans have. But one of the things that I would say is for the best qualified borrowers with bank statement loans, either big downs or a bunch of equity on a refinance and high credit scores, we had those down into the low threes on that program. And right now, just the investors that buy those, where the secondary markets those get sold into, when rates spike, they just said, we don't want anything under 4%. So if you're one of those super well qualified borrowers, yeah, it hit you. It was probably 0.5% to 0.75%, just like everything else. But when I hear 6 3/4, it could be an awful rate. It could be a perfectly good rate. We got to talk about what are the credit scores. The higher the credit scores, the lower the rate, and how big is the down payment. The bigger the down payment, the better the rate. So if you want a second opinion on that, if you want us to take a look at it, I'd be more than happy to. The other thing is, if it's a lender that is a non-QM lender, like they work at a non-QM lender and they only have one option, they could be way worse than what else is out there. When we get a borrower that has a bank statement loan, we literally shop it with like 7 or 8 different lenders. And that's different than if you come through and we're going to do an FHA loan for you. I have a program called Loan Sifter. I just plug in the parameters and it comes back and it gives me 100 different lenders pricing. It's not that easy with the non-QM stuff. You literally got to go through it, look through their guidelines.
You got to look through the Scotsman's Guide.
Yeah, look through the Scotsman Guide, find out who's doing them. So no, it's actually effort and work. So we're going to call 6, 7 different lenders until all of them have told us a similar number, or 3 or 4 of them have told us a similar number, kind of what the floor is on that. So again, could be a terrible rate. It could be a decent rate. There's no way of knowing without knowing all the details. So Jeb, why don't you throw up the emails there if they want to reach out, if you want to follow. It doesn't matter where you're at. The rates are going to be the same wherever you are in the country. So even if you're outside of California, we can tell you how it looks and how it possibly could or should look.
Good stuff. So Sierra has a question here. Is it better to go with a mortgage broker or bank lender? So here's the difference, right? A bank lender, for example, has their own products. You walk into a bank, they have what they offer, and that's it, right? You either fit their guidelines or you don't. And sometimes their guidelines, although they have loans that are Fannie Mae, Freddie Mac, even some FHA, they typically have overlays on those programs. So it might not be the true guidelines that Fannie Mae, Freddie Mac, FHA, or even VA put out. They've kind of doctored them a little bit to kind of fit their portfolio of loans that they're looking for. Because a lot of banks keep their loans, right? They're portfolio lenders in some cases. In some cases, they sell them off to Fannie and Freddie or whatever, but they have their products. Brokers, and let's be honest, I was a broker, so I'm biased in this sense, but there's a reason that I'm going here. Is brokers have very few overlays, right? And if there are overlays with certain lenders, they have the opportunity to shop with multiple banks, right? Josh, for example, is probably approved with 20, 25 different banks. So he has the option to say, again, like you mentioned a moment ago, loan sifter. He can put your scenario into a program, if you will, that will come back and say, this is the best rate and term fees for this particular scenario today based on this situation. And there might be 20 banks in there, or 100 in some cases. Whereas Bank of America, for example, you walk in there, they don't have that option. They have what they offer, and that's it. And if you don't meet their box, if you don't fit inside that box, there's no loan, right? I used to have a contact when I was back in the mortgage business at Bank of America, where the loans that didn't fit their box, he would refer them over to me. And guess what? 9 times out of 10, we could do the transaction when Bank of America, in this case, Bank of America could not, because their box was smaller than my box, right?
Everyone's box is smaller than your box, Jeb.
It would be bigger than my box.
I think we're talking about. But anyway, we're talking about two different things, Jeb.
Anyhow, so brokers, in my opinion, are better. I'm not even going to let Josh answer the question, because obviously self-fulfilling for him.
No, you want to know the funny thing? What we've answered that in 2 years or a year and a half of doing this show. I probably answered that 3 times. And I was going to say, why don't you answer it from your background as a broker and as a realtor? What's your perspective on it?
I refer my clients to brokers. Simple. Have I referred my clients to bigger banks? Absolutely. Occasionally when somebody comes to me with a pre-approval from, say, a Wells Fargo, right? And they want to work with Wells Fargo, I say, you know what? Absolutely. Wells Fargo is a great bank, but let's try calling my contact there just to see how it is. Because again, it's not each person at the place that you're looking to get your loan is the same, right? Some are experienced, some are experts, some are not. Some are in a call center, some are actually out grinding for business and have been doing it a long time. Again, it's a long way of saying brokers are better. So that link that I put up earlier, there's one in the description. We'll get you in touch with one of those if you need it. Willing has a question here for you. Just saying, do you prefer the builder to include all the cost in their draw schedule? Does this hurt compared to the B?
He didn't hear the part where you told him that we don't do construction loans.
Okay.
Unfortunately, I will be zero help. Hopefully, in the things that I do know, I'm a fountain of knowledge, but the things that I don't know, I'm worthless. And in this instance, I'm not going to be able to help.
There you go. Chris from Newport Beach, just found your channel. Love it. First time buyer looking to buy soon, but need more general info on how to buy, terminology, where beside Josh should I look? So here, Chris, again, reach out to me. My email's above. I can direct you. I mean, my channel, honestly, like, I'm not tooting my horn because it's not that, but my channel is honestly built around people just understanding real estate. If you take out the housing market updates, that sort of thing, it is really evergreen content. Most of it can be used in any market, just understanding the basics of buying, selling a house, and terminology, right? I mean, cash out, what's a cash out refinance? What's a refinance? What's a more, like, all of that stuff's on there. So just check it out. I do, playlist on there that you can go through and get some information, but there's also a lot of great, knowledge on YouTube, other channels out there as well that I can direct you to, people that break stuff down and easy to understand terminology and ways. So again, feel free to reach out. Happy to direct you, or just go through my playlist, man. And I'll, and if there's a video you want made, reach out. Right.
I'm happy. Guys I know, Jeb, might be working on that kind of a project.
Yes. We are. We can talk that. So we haven't gotten a date. Are we throwing a date, Josh?
First week February? Want. Let's do it.
Let's save it. Well, here towards the end of the show, at the end of the show, we'll mention what we're doing. We're going to do a first time home buyer webinar, give people, some good information. So if you're here at the end, we'll talk about it in more detail. Let's see. Do you make money selling pocket listings? Yes. Typically you negotiate a commission with the seller when doing a pocket listing. Even if you're the buyer or the seller, there's usually some sort of commission made. Marcus, hard to say whether you should buy a townhouse or not in Vegas. Again, depends on your life situation, what's going on. Financially sound, money in the bank, time horizon, all of those things are important in the process. So unfortunately, without having that, it's a little bit difficult to answer that question for you, unfortunately. Should I back out of my new construction build in Cali due to the combination of increasing rates and Mello-Roos tax? Scared I'll be stuck with a huge payment when the market crashes. So I'm just going to ignore
when the market crashes.
Yeah. I'm going to ignore the last part of that question because, again, the market's not going to crash. But if you, what happens if you're in new construction right now, Josh, and you're considering interest rates rising, right? I mean, Mello-Roos is one of those things that you need to know up front, right? If you are buying new construction, Mello-Roos here in California is it's, some states have a similar tax. It's called different things in different states, but essentially what it is an infrastructure tax in building out a new community, right? So if they build a new community in an area that might not have streets, might not have sewers, schools, grocery stores, playgrounds, any of that stuff here in California, when they do those communities, they essentially, there's a tax associated with it. They sell bonds in order to get that money. And essentially what you're doing is paying that bond back over time. There's a time limit on them, 25, 35 years, depending on what type of bond, how long, all that good stuff. So eventually it goes away. But if it's new construction, you're going to pay it. And it ends up raising the property tax. There's no way around it. But Josh, sorry to drag along on that one. Thoughts on what do you do in this scenario?
I always caution people when the bright shiny thing is new construction. So you see it and you're like, oh, that's bitching. I can pick some of my own finishes. They're going to be lower maintenance. A lot of these communities have Mello-Roos, and a lot of times when you'll see, they'll be a little cheaper. Say, well, it's cheaper. We'll say, well, by the time we look at Mello-Roos, and many of them have a homeowners association, you could buy a more expensive home with a similar payment. So not to sort of hijack your question and go that direction, I don't love Mello-Roos. I just don't. And if they're egregious, some of them, they add a little bit to your taxes. Some of them are really, really high. I don't know that I would look at changing my mind on what I wanted to do. So Jeb and I talk repeatedly. Buy a home as soon in your life as it's right for you. You're established in your career. You're in an area that you want to live in long term. Your relationship status, either pro or con, of who's going to be around and living in the home with you is settled. If that stuff made sense 6 weeks ago, it probably still makes sense now. Neither of us think there's a crash coming. Neither of us think that interest rates are going to stay high and elevated long term. So you get in, and whether it's 1 year, 3 year, 5 years from now, literally for the last 40 years, every 2 to 4 years, we've had a refinance opportunity. You will have an opportunity to drop that interest rate, even if you do end up at a 4% rate.
And here's the other thing I would ask you to consider is that from the time you've gone into contract, have the homes in that community where you're looking gone up in value, right? Were you in early enough where now they're building maybe another phase that values are higher purchase price wise than they were when you went under contract? If so, maybe it's worth staying in it because you've got equity already in the property versus going out and trying to find something, to purchase again. So there's some things that you need to figure out on your side to see if it's worth it or not. So it's Sci TV, Josh. So
we never would have got that in a million years.
We'll not screw that up anymore. So Chris is asking, buying a home with 5% down, bad idea? No, not necessarily. You've got to figure out what's right for you, right? Again, the things we talk about is being comfortable with the payment, reserves in the bank, longer term time horizon. Josh, we had people buy last year, in fact, 3.5% down on an FHA loan, and were able to refinance in the same year and get the PMI or the MIP, whatever, on an FHA loan dropped, right? So they gained enough equity just by getting in the game to get it, canceled during that time horizon. Now that's not normal, but if you're comfortable with the payment, you have money in the bank, who cares, right? I mean, I know people tell me, they probably look at it negative when I'm like, who cares what happens to your home value over the next couple of years? Because it doesn't matter unless you're going to sell your property, right? It does not matter where the value of your home goes if you don't plan on selling that property. If you can make the monthly payment every month, that's really all you need to really worry about. Now, I know that we're in a generation right now that, there's so much technology and you can watch the value of your home hourly and, between Redfin and Zillow, and you can watch stocks and all this stuff. You just tick up, tick down. Don't do that, right? Just get in comfortable with the payment, hold on long term, you'll be happy. It's a win-win. Josh, anything you want to add to that one?
So I would say, look at the flip side of this. Do lenders want to make bad loans? So of all of the factors that go into prediction or likelihood of foreclosure, one of the least predictive is the size of the down payment. Credit score is much more predictive, any number of factors in there. The size of the down payment is predictive of loss severity for them if someone ends up losing the home, but not of actually incurring a loss. So you want to make sure the lower the down payment you have, you do want to be more careful, make sure you're not overbuying, having a higher payment or a higher percentage of your income going to your payment. You want to make sure you have reserves. We talk about this a lot. And again, Jeb, tonight's just the conservative show, talking about all the conservative side of it. I don't like seeing my clients use every last nickel they have to buy. Referred a client out to a realtor today, and we were going through it. And with rates up, when we first started talking, a 3.25% rate on their VA loan would have been no cost. We would have got enough of a lender credit to cover all of their costs and keep their $20,000 in the bank. And now we're sitting here today, that same rate doesn't have a lender credit. So they're not going to, they're going to use all their money for closing costs, or we're going to take an even higher rate. For me, if I'm making that decision, give me the higher rate, slightly higher payment, and give me some reserves. So those are the things you want to look at holistically, the whole big picture. Where are you at in life? What is your credit score? What are your other savings? It doesn't necessarily mean it's a bad idea.
Good stuff. And I just realized by clicking down the comments, so we got a lot of comments. So we're kind of like we were last week, guys. We'll try to make it quick and get through some of these. I realize there's some duplicates in here that we can ignore, but Willing did say Fed raised the conforming limits to encourage the sellers to keep raising the sales price. Graham said this. No, I mean, they've done it for, I mean, not forever, but they've always adjusted with inflation and rising cost. I don't think it's to raise, it's to give people the ability to actually purchase more home based on the direction of home prices, right? Because if they kept the conforming loan limit low and home prices continued to go up, which they would, regardless of whether they raise that or not, you just got less people being able to purchase property. So it allows that opportunity. Josh,
Look at it this way, Jeb. It's not a decision. They don't go hey, do we want to raise limits? Okay, let's raise them to this. It's written in their guidelines. Every year, they're going to look at the FHFA home price index, and they're going to set the limits for the next year. So that's one reason why the answer is no. And the other is, anytime someone throws a conspiracy theory out to you, you got to ask why. Why would the Fed want sellers to keep raising their sales price? What possible benefit is there to the economy other than homeowners feeling as though they have more equity? I would love to hear the theory on why the Fed would see that as a benefit and put them in a better position.
There you go. Sonny, can I use my paid off house as collateral for a rental property purchase? So Josh wanted to buy a rental property. I have a paid off home. Can I use it? How does that work?
So it's not really going to secure the new loan. You would do a cash out loan, put a loan on that property and buy the other one cash, or you would borrow some money, use that money for a down payment. They're not going to cross collateralize it. Most of the loans that we talk about here on the program, Fannie, Freddie, FHA, VA, they won't collateralize two properties, cross collateralize and cover two properties. So yes, the answer is you can absolutely do it. You're just going to borrow money out of the one house and pay cash for the rental property.
There you go. Good stuff. Victor, yes, I do. Reach out to me. I know that's up near San Jose, Stockton, all that area up there. Yeah, reach out to me. I'm happy to put you in touch with somebody if you need it. We talked about rates at the beginning of the show, so we can go back and check that. Aaron, are there any good sites outside of Zillow, Redfin that you can give a good idea of what your home is worth? Not really. Even those aren't great. I have a tool that I put clients on that, in fact, it might work with where you are now. If you go to my website and click on what's my home worth, you fill out your information, it'll keep you up to date every month on what the value of your home is now. But I'll be completely transparent with that, is that it's not 100% accurate by any means. In fact, I would say it's wrong as often as it is right, just because, like any of those systems out there, they're not able to break down the information the AI, the algorithms aren't able to break it down like a realtor that knows an area or knows the location or knows the upgrades of a property and all of that stuff, right? It's just using similar size bedroom, bathroom counts in order to get a property versus using specific comps in a neighborhood per se that might be model matches or might be, closer in comparison in order to get that value. So with that said, I don't really have, much to add. So there you go.
We got a couple good ones down here. So keep looking at what you're looking at.
All right.
Billy Kane says, is FHA value appraisal inspection more strict than conventional value appraisal? Sorry if the term is not correct. Not really. One of the differences is that the FHA requires the appraiser to do a visual inspection of the property and note any things, including looking up into the attic. So it's a little bit more strict, but not really. They are more strict on things that can be considered a health and safety issue. So Jeb, from your perspective as an agent, I know some agents believe this, and it is slightly true. From my end, I've never really seen it become an issue other than FHA will not allow chipping, peeling paint on a pre-1978 house. But from your perspective?
Not really. I mean, I'll be transparent, right? I don't do a lot of FHA loans here in Orange County. Occasionally we had, I think we did 2 last year, where I was the listing agent and buyers came through and did an FHA. So, no, I don't, there's not really, I haven't come across many issues where it's been a problem. Now, if some of these properties were an FHA loan, again, the peeling paint would be something that came up, but that's really the main thing here in Southern California. Other than that, not really. They do have to have a termite completion. That's something that has to be done. Whereas
FHA doesn't require it anymore. A few years back, they changed it. It's negotiable in the contract. If you ask for it in the contract, then it will be required. But you don't have to have it anymore. VA is the only one left that absolutely requires it.
There you go. Well, so no, the easy answer is no, not really a big thing. But the most common things I see with appraisals, honestly, being an issue is people not having smoke detectors, carbon monoxide detectors, and the water heater being strapped properly. Those are things that appraiser comes out, it's not done. They have to come back out and do a re-inspection to make sure that stuff's done because the lender requires it. That's a bigger problem than any of the other things that we're talking about here. And that's easily solvable for the most part. I'm going to hit that super chat here in just a second, but I'm going to answer this question real quick. Coinster, are you seeing any trends in San Diego market here? Inventory in San Diego has shrunk dramatically in recent months. So talking to Dan Parker tomorrow night, 5:00. You can view the link in my community page there live. We're going to be talking about, he's in San Diego. We're going to be talking about San Diego and Orange County real estate. But what I will say is at the start of the year, we had about 1,000 homes on the market. I think San Diego had about 1,200. And San Diego is bigger, I think, as a whole than Orange County, and not really that much more inventory. So I know inventory is a huge problem there as well. Not much of a change. Let's hit this. Maddie saying, evening gents, how does seller financing work? Always comes up with creative financing options when perhaps cash isn't abundant. So okay. So seller financing, in order for a seller to do financing on a property, they essentially have to own the home free and clear, right? They have to have no mortgage on that property, at which point they set the terms of the financing, right? They might be willing to loan you 80% of the value of a home if you put 20% down at whatever terms they decide, right? There's a grant deed drawn up. There's still an escrow involved. There's still the normal procedure in that process. Josh, anything? I mean, you could probably explain this a little bit more detail. It's not
Well,
common, but
here, let's
there are
use a
some.
super
Yeah,
simple story. The
yeah.
first house I bought, my step grandpa was the listing agent. It was a past client of his. She owned the property free and clear and did not want to get a lump sum of money. So she said it was a condo. It was $197,000. She said, if you put 10% down, I'll do it. You tell me what, because I was in the mortgage business, you tell me what the going rate is. So she beat it by 1/4%. So we got it for 6.875 with no mortgage insurance, with 10% down. And I showed her all my stuff just like I would show a lender. Here's a credit report. Here's my paycheck stub. Here's my W-2. So you see I can afford it. And it works just like any other loan. Just I write her the check every month. There still has to be loan docs prepared. There's going to be a note. There's going to be a deed of trust securing it to the property. So it's really not all that different other than you and the seller negotiate the terms and they can do anything they want. You can agree to anything you want. So a lot of flexibility in that. It's not going to show up on your credit report. A lot of this happens when investors get to the end of their investment life and they want to start cashing out of properties, but maybe not truly just cashing in. They would rather have the cash flow of a mortgage paying them every month versus the headaches of a tenant who may or may not pay that they can't come in and foreclose on.
There you go. Jordan, what do you anticipate spring inventory will look like in Raleigh, Durham? I don't. I mean, that's where I'm from essentially. Grew up and raised.
How
Uh,
far is it from Kinston?
about an hour, 20 minutes, maybe, depending on where you are. And Durham's obviously a little bit further. But, again, we don't know that market well enough. I do know inventory is a problem. I know some great agents there if you need an agent to talk to. I would think it's going to be like most markets, right? Raleigh, I know it's seasonal to some extent, right? You guys just got snow and bombarded with some crazy weather. So as the spring starts to come around, you're probably going to see more homes come on the market. Now, what does that mean? Hard to say at this point, right? I mean, I would have thought you would see more inventory here by now, but you've seen it come on, but it's just being taken off almost immediately with buyer demand. So really depends on what buyer demand does out there, whether or not you see inventory really pick up, because there's still people that want to live in Raleigh, RTP area and have a different lifestyle and a better more desirable area with less cost of living and all that good stuff. So hard to say, but I would think it's going to be a lot like, probably last year. I mean, probably going to see a strong market for the most part, just because of, people wanting to live there. Josh, here's a good question. This is a tough one to answer though, but in escrow for a property with a purchase price of 2.2, average selling price in the neighborhood is 1.5, but it has an ADU. It's a one bedroom, one bath plus a studio. Do you feel this was a good deal? What's the best way to run comps when there aren't comparable properties? Would you pose an issue with appraisal? Would this pose an issue with an appraisal? So, thoughts on ADUs and value and that sort of thing. I mean, I know there's not a straightforward answer, but I'll give you my take as well.
It's a tough one because what we're saying, if you think the neighborhood should be 1.5 and you're at 2.2, you're saying $700,000 value for a one bedroom, one bath plus studio. That's a lot for a door, even in a neighborhood at 1.5 million. Comes back to me to what are you going to do with it? Can you rent that out? Does it make your payment more manageable than what you would otherwise have with a 1.5 purchase? Is it just going to be somewhere where you use to do work? Use it as like an office or a studio for yourself? Those would be the big things I would look at, but it can be very difficult. A lot of with the changing ADU guidelines, we didn't have those 10 years ago. So there's just not a lot of comparable sales.
Yeah. To answer the question, could the appraisal be an issue? Absolutely. It could be an issue. Now, what I will say is when appraisers do this sort of thing, they're not going to just look in that neighborhood. They're probably going to go out and in other areas to find properties that had ADUs that sold to try to get a comparison of what an ADU might be worth. Maybe, and then make market adjustments to location or make adjustments to location and that sort of thing based on where the other comparable was. So it's not an easy answer to it. A lot of it, what can you bring in rent wise on that property? Kind of work your numbers backwards to say, okay, comparable properties are worth 1.5, but are you on a bigger lot, right? Chances are, if you've got an ADU on it, maybe there's a bigger lot. So are you taking the bigger lot into comparison versus those that are selling at 1.5? Because sometimes that can be a couple $100,000 in value just in itself, not even factoring in the ADU. So there's some nuances there. How did they come up with the 2.2 price to start? Maybe ask the agent on the other side how they came up with it and backtrack. What's it cost to build that ADU in this market? How many square feet is that thing? Because that's, building cost is going to factor into how they come up with the value on that deal, just, because it's an ADU and all that good stuff. So there's a lot going on there. Not really an easy answer. Yeah, sorry. Unfortunately, you've stumped us.
Couple good and easy ones here.
All right.
We got KPS ASAP says, good morning.
Good morning.
Good morning. It's late in the afternoon. My loan early last year was 2.5 FHA. Should I refinance to a conventional?
No.
So 2.5, you got mortgage insurance at 0.85. You have a 3.35 effective rate. Conventional rates are higher than that right now. So you're gonna have to look for a better opportunity when rates decrease at some point in the future.
All right. So backup offer questions. If the property is still under contract, can you still submit offer to the selling agent? You can. I would say usually, especially in the market that we're in right now, probably a waste of time. Most properties, if they fall out of escrow in this environment, are going to go back to the market unless there's a really, really strong offer in backup that they just want to slide right into. So it might be worth it talking to the agent on the other side. Typically, I don't really do backup offers per se, but I will call agents that submitted offers on properties if something falls out and just say, hey, look, something happened. We're going back to the market. Is your client still interested? Yes. Okay. Then we'll consider your offer. And we may or may not just look at something like that, or we may go back to market and then still consider that plus any new offers. If I don't like my loan officer, can I switch? Absolutely. Now, here's the thing. If your loan is with a bank, you have an approved, a locked rate, you're in underwriting, can you switch? Probably. But you need to go to upper management in order to make that happen. Now, if you're just starting the process, you're working with someone, you haven't really gone through that process, you can switch anytime. There's no issues with switching. Just keep in mind, if you are in escrow, you don't want to switch anything that's going to derail the closing of your transaction, especially if if contingencies are released overall. So just make sure if you are switching, you're doing it before you get too deep into the process. Let's see. Do you ever have issues with neighbors? No, I haven't personally. I did have. So do you have issues with neighbors claiming some type of property line dispute when listing or buying a home? I haven't personally. Most of the homes that I sell have there's lot lines, right? There are fences on the lines already, block walls, fences, something to show you the more or less the true property lines. Areas like Texas, North Carolina, some of these areas rural don't have fences, right? It's just land goes forever, and hell, they don't even know where their property ends. So in that situation, probably a survey or something like that would be more reasonable to do in a transaction. I've only had it happen maybe one time, and it wasn't even a listing I had. It was a client I was talking to about getting a listing. In fact, it was over in Anaheim, right across from Disneyland, and she swore that the neighbor had built the fence on her property line, and she ended up being completely crazy to start. So I didn't get the listing, and thankful for it for many reasons, but that was the only time. And then side note, I did have last year a property that closed escrow. My clients moved out. I was the listing agent, and they moved out, and they were gone like maybe 4 or 5 hours. And as they were gone, the neighbors knew that they were leaving, came and cut the tree down in their backyard because they didn't like the fruit hanging over the wall. And so when the new owner showed up, the tree that was in the backyard, the big lush fruit tree, was gone. They had completely cut it down. So I guess that could be a property line dispute. Fortunately, they were able to work something out, and there was no craziness there. But yeah, for the most part now.
Building builder SIP wants you to know that he knocked the dust out of that like button.
I like it. I like it. We're at 146. Look at you people. You doubled it from when I asked last time. I like that. Let's see here. Because he did that, he wants to comment on rising rents. Do you see them having higher gains than mortgages? Rents increasing. I mean, here in California, right, there's a limit at the moment. Well, not at the moment. There's a limit on the amount you can increase year over year. I think it's 5% plus inflation. And so I recently had someone reach out to me asking me about, whether or not their increase on their rent was actually legal. And I looked up what inflation numbers were here in Orange County, and it was about 7% plus the 5% that they could raise. So, their rent was being raised 12% from one year to the next. And essentially it was legal. So I don't know that the market can sustain either the interest rates and or rentals appreciating at that rate. So I don't think you're going to see, at some point there's got to be some moderation in both of those numbers for many reasons. But I do think being in a rental in this market it's volatile, because there's such high demand, a lack of supply out there to choose from. Renters are getting top dollar for rentals. In fact, I mentioned earlier in the show, I rented one last week, I guess last week in Garden Grove. It was listed at 2,900. I received 100 applications in less than 24 hours. I had to shut it down, or calls rather, in less than 24 hours. I had to shut it down because it was too crazy. We ended up leasing it for more money than we initially intended because there was demand there. Thoughts on this question, Josh?
It really, the thought that comes to mind when you say something like this is, what will the market bear? So, my property in Orange, we have it on the market right now, and we're setting a price, an asking price. We haven't agreed to a lease yet. And what's the number? The number is, what will the market bear? How high can I set that rent and still have an acceptable pool of tenants to pick from? If I set it $200 higher than I did, I probably would still be able to rent it. It would take longer, and I would have to take whoever's willing to step up and pay that much. And then you have to deal with the possibility that they might be like, well, I pay top dollar, I could do whatever the hell I want to the house. So, long way of saying, how many potential renters do you have, and what are they willing to pay for it? At a certain point, you hit a breaking point, and they just go, I'll stay where I'm at. I'll rent something cheaper. I'll go look at another alternative. So right now, there's less places to rent than there are people wanting to rent them. So landlords have a lot of power, but it's not infinite power. I didn't raise the rent on my tenant in the property I inherited from my dad because he's awesome. The money's in my account the first of the month by Zelle. He doesn't bother me. He brings mail over if something pops up over there. It really comes down to supply and demand. The numbers are going to level off at some point.
Yeah, and manage a couple different rentals. I would say less than, about 30% raise the rent, and it was by a little bit. Like, I mean, we're talking, less than 5% year over year. So, not everybody's egregious, but some can be. Let's see here. There's two questions that I'm going to kind of pull together. Derek's asking, are people still in forbearance, or is that no longer a thing? So the numbers just came out. We're at pre-pandemic levels. I think the forbearance numbers dropped below 1.9% of people in forbearance. So super low numbers. We're back to, again, pre-pandemic. And so to answer Sheena's question, the answer is no. You're not going to see foreclosures come on the market. And if you do, they're going to be market value for the most part. You're not going to see any crazy deals out there because there's just not. It's last time was different because foreclosures came and they added to already high level of supply on the market. So, they had to sell these things at a discount in order to get rid of them. That's not the market you're in right now. So if you do see foreclosures come on the market, chances are if they're priced low, it's because there's something wrong with them. There will be an investor purchasing those. It's going to be difficult to buy a foreclosure and get a deal, in my opinion. You might see more of them coming to the market just because of moratoriums expiring and that sort of thing. But I think it would be difficult to get a deal in this environment because of the amount of demand out there. Josh, you see any
I got a good
question?
one. Victor says, is CoreLogic a good source to trust? CoreLogic mentioned that the Modesto area has 50 to 70% chance of a price decrease. To me, this sounds good since I'm trying to buy in that area. Again, we always want to be careful, us Southern Californians, where everything is basically built out, making broad statements about an area like Modesto. But whenever I see these articles, they come from seemingly reputable data sources. And when you look, they are generally looking at a linear price trend. And they're saying, hey, if we fit the price growth of how it's historically gone up in any given area, we are 30 or 50 or 80% above where prices should be. And it doesn't take into account changing incomes in the area. It doesn't take into account interest rates being higher or lower. So you got to dig into the numbers. I haven't seen CoreLogic's numbers, but every one of these articles I see, I look and I go, yeah, some of these areas look overpriced to me, but we said that last year and they went up another 10, 15%. And some of those things are getting changed. A thing that has changed that you can't look at an area like Modesto. Say someone got priced out of LA and wanted to buy a home. 3 years ago, they probably couldn't move to Modesto. But if now their employer says, hey, you don't need to come in the office, they go, Modesto looks pretty good to me. So that's additional demand in markets that didn't otherwise exist. And they're talking about it as location arbitrage. People in high cost areas that no longer have to live in high cost areas are moving to lower cost areas and pushing the prices up, which can skew the numbers for reports and things that you see like this. But I'll try and dig into it during the week and see what methodology they're using for coming up with these numbers.
There you go. Here we go. Cheppy. Do you work with people on Social Security, disability income? Any advice would help. So, Josh, can you buy a house and have disability income?
All income is income. The requirement that we have to have is that we have to prove continuance for 3 years. So if you have a kid, you're getting child support and they're 16, it's going to stop at 18, we can't use that. But for the most part, all types of income that we know are going to continue can be used. This really comes down to a debt to income issue. I've had people call up and say, people are telling me I can't buy because I have Social Security income or disability income. We look at it and say, they're not saying because of the type of the income, they're saying because that's the only income you have and it's not enough. So that's what we'd want to look at. There's no reason why we can't use that income. It just becomes, is that income enough for you to qualify a property in the area where you're looking?
All right. PZ Playas. Maybe. My realtor keeps
So I want to know what PZ stands for.
Maybe it's please players.
Please players. That's better.
My realtor keeps telling me to waive appraisal. Home inspection is the first time home buyer. Is this a risk I need to take to buy a home in New Jersey? So I can't tell you if it's a risk in New Jersey. I would tell you if you trust your agent, you believe in your agent, there are times when when it's 100%, it has to happen in order for your offer to be considered. I will say that. Does it have to happen in every situation? No. Last year, 30 something transactions done. I would say that we waived the appraisal on probably less than 10% of them. No, let's say 20%. So less than 6 of them had appraisal waived. So most of them, we didn't have to do it. Now, in some situations we did. In fact, I did it on the last couple of offers and we still didn't get them accepted. So depending on how competitive your market is, your agent should be running the comparables before making an offer and saying, hey, listen, there's a chance based on what you're offering that, hey, you're good to go with the value. There shouldn't be an issue because these comps support it. Or in some cases, like, listen, there's nothing to support the offer that you're putting in and waiving appraisal. And you might have to pay some sort of gap there. So you need to know and understand the risk. I would say trust your agent. If you don't, find one that you do trust. Peta Chan, what's the average amount people are offering above the asking price in Orange County? We lost on our first offer. Someone offered 900 for an 820 house. So I don't know that there's a percentage. Again, it's a little bit different in every scenario. I would say look at the comparables in the market that you're looking in. Look at the last, say, houses that have sold in that area and see where they've sold above the asking price to get an idea of what things are doing. Now, that's not a hard, fast rule, but it should give you an idea, because not everybody's going to be the same. Not everyone has the power, the buying power, in order to be able to offer above and the asking price in some of these situations. So it's going to be a little bit different. Again, if you have an agent, trust them. If you don't, reach out. All right, we're pushing close to 2 hours. So a couple things I want to mention here as we do this, and that is Josh and I. One thing we are going to do is we're going to start doing podcasts. We're going to turn this into a podcast so you can listen to it outside of watching it on YouTube, for one. So if if you want to work out and be really motivated, you can listen to us talk about housing. No, but in all seriousness, this is going to be turned into a podcast. The format's going to change a little bit in order to accommodate it. We're going to do some other stuff on there as well to really help home buyers through that process. So that's one thing that's going to happen. And that's going to happen here in the next couple of weeks. So we'll give you that information as we do. That way you can listen to it and not have to stare at our faces in the process. Secondly, first-time home buyer seminar is going to happen. We're still ironing out the details of how this is going to work. Essentially, for the most part, there's going to be a free webinar where we outline the home buying process. From there is going to be another opportunity for you to get more detailed information, really grind into the process in detail. And we'll have all this information coming out here. Ideally, we want to start this thing probably first week of February. So we're looking 2 weeks to get this dialed in to the point where if you're a home buyer and you want to do this, we're going to start putting out some interest list here in the next couple weeks. Josh, anything you want to add on that, bud?
No, we always talk that in our warm weather state here, and even in less warm states, spring buying season really kicks off after the Super Bowl. So we want you guys to be able to be prepared. So if we go first week of February, Super Bowl is Sunday, February 13th. We get ahead of that. So once the late winter, early spring buying season kicks off, you'll have all the information that you're looking for and need to make good decisions. And we can go a little deeper in that format than what we're able to here, just answering questions.
No, and I realized that some of you guys came in at different times, posted questions. Typically we do this show for 2 hours. Again, 2 hours, a long time. And I realize people want their question answered. So after this ends, let it end. Go post your question in the comments. We'll do our best to get back to them. I answered a lot of questions last week after the show. So if we didn't get to your question, do that and we'll get to it. But we're here every Wednesday. If you show up early, got a better chance of getting your question answered. But there's a lot of value here. A lot of these questions are repeats. So if you go back and watch this stuff, or here in a couple of weeks, go back and listen to it on a podcast, you'll be able to get your, the knowledge that you need in order to help you buy a property. Josh, where are we at here? We're pushing an hour 56. I'm going to do my shameless plug once again and ask people to hit the thumbs up. I think I'm going to do that. I am going to do that, and we're going to do that. So if you're watching now, 289 people. What are we? 164 likes. Can you get it to 200? That would be nice. I'm asking a favor, people. If you found any value, please do that. Also, if you are looking for a real estate agent, a mortgage professional anywhere in the U.S., there's a link there. It's also in the description. Click it. There's no cost. None of this stuff costs you any money to help guide you with somebody that does a good job. A lot of reached out and said thank you. So thank you guys for trusting us and giving us that opportunity. Josh, final words, anything?
No, there was an awesome question up here that I love.
Well,
and it says, Kristen says, hey, Jeb, which city's better, Huntington Beach or Fountain Valley?
Everybody in Newport would say Newport's better.
Yeah.
Even if that wasn't part of the question.
Will one up them and say, no, we're
even
better.
If that wasn't part of the question. But which city's better? It depends, right? I mean, they both, honestly, it's essentially the same damn city. I mean, for the most part, I mean, it's really the same area, the same location. I think Huntington has better schools, quite frankly. High school wise, a lot of the districts feed into Huntington, but I think if you can find a great property in either one of those, you're be in good shape. I don't know that there's Fountain Valley is a lot smaller, so there's a lot less options out there. Yeah, I think your competition's a little more fierce at the moment because again, there's less property to choose from in that small area. But I live in Huntington for a reason, so I wouldn't move to Fountain Valley just because I don't want to live in Fountain Valley. I want to live in Huntington. So That
But
should give you a little
the
insight.
the flip side of that is there are a lot of people that would say, no, we prefer Fountain Valley. Enough people that prefer Fountain Valley that
And
if you
that's
want
okay.
to if you want to invest in either one, they're both great cities. Just they appeal to different people.
Yeah,
So,
exactly.
Jeb, you would ask kind of what my parting shots or last advice here is. Someone once told me, and it helped me, although I'm a little high strung and still get away from it, is nothing is ever as good or as bad as it seems. So whether it's interest rates, whether it's competition and low supply that's got you stressed or worried, nothing's ever as good or as bad as it seems. Be calm, keep your wits about you. Don't fall prey to FOMO or worrying that things are not going to work out for you. Think your way through it, talk to expert advisors, and make good decisions.
And I like that. I like ending the show on a positive note, some some motivation, if you will, some little personal growth there for the people out there watching. And I'll add to that. Don't sacrifice. Don't sacrifice on the things that are important to you in buying a house just to get a house. Right? It's great for home ownership. It's great to build that long-term wealth by owning real estate, but don't do it if you've got to hate where you live or hate the property that you're in just to get real estate. Make good informed decisions. There will always be an opportunity. Things happen for a reason. I truly believe that. So if you don't get one, there is an opportunity for you. It always ends up being better. But that's where we're going to end it. Thank you guys. Hit the like button if you haven't already. Have a great night. See you next Wednesday. Adios.